Well, hello, everyone. My name is John Humphreys. I'm the Executive Director of WEF, a school funding group. We've been around for over 30 years, focused on revenue limits. One of our big opportunities is to try to help school districts squeeze every dollar. And we've got Matt Silkey, Vice President from PTMA, to talk with us about market opportunities and also about their cash flow analysis tool. One of the interesting things that districts run into is probably everybody here knows is that your cash doesn't come in evenly each month. Right now, you might be rather low on cash, but there will be sort of a tranche of dollars coming in later, certainly when the local property taxes are. And so there might be opportunities for investment there. And the cash flow tool can help you identify when you might be light and when you might have an opportunity for investing. So Matt and I have been doing these sessions for a few years now, and it's been nice to have Matt through some interesting banking times, and look forward always to your analysis, Matt. Thanks for joining us again today.
Yes, thank you again for having me, John. Good to see everybody on here again. I'm going to go ahead and share my screen. I'm going to send you the request.
I had allowed that previously. Sorry about that.
No problem. Let's see which screen I got here. All right. You should be able to see. Yep, there we go. All right. As always, again, thanks for the intro, John. Good to be on here. I think we just talked about, I think we've been doing this now for 3.5 years on a semi-annual basis. Um, so today, and I know in the past we've talked a bit extensively about some things that don't necessarily relate to the day-to-day for, people that in the municipal public finance world. So we're not going to talk extensively about any of those things today. We're going to talk a little bit more about what controls sort of like the yields behind where people are going to be investing and where they might be paying on some of their borrowing. So this is going to be things like inflation and jobs, Fed expectations, and then that kind of leads us into, the investment yields in the municipal market, debt yields that people are going to be paying. Obviously, this is a time of year where a lot of people are kind of running short on cash, oftentimes leading to, not being able to fund their liabilities, and so they kind of go into a short-term borrowing. I believe last year, 107 school districts in the state of Wisconsin needed a short-term borrow to some degree. And so we're going to talk a little bit about that. And then I know you had mentioned our cash flow software and kind of, the investment component behind it, but it's just as important, at least for how we use it to kind of identify those shortfalls for people that do need to short-term borrow. Um, and so, yeah, I'm going to try and run through this here. I don't know how much time we actually allotted, but I'll try not to take up too much time. So first things first, kind of talking a little bit about inflation and price stability. Um, Inflation's really been more or less level since it really came down off its high, kind of like around Q3 of 2023, and it's been kind of ticking downward ever since, just ever so slightly. Disinflation continues on sort of the service side of things, but the figures are really being kept afloat by, the goods that are going to be a bit more expensive right now than maybe they have been in the past. Kind of sitting right around 3.5% for both CPI and core CPI. Core CPI just being basically remove the volatile goods, meaning like energy and food and stuff like that. There is some good news kind of on the tariff front. Tariffs, we're going to talk a little bit about those today. They're really keeping up the price of some of those goods. The White House has reached, preliminary deals with China. India, a deal was reached, I believe, last week. Um, and the Fed kind of feels as though, that impact from these tariffs is reasonably going to be short-lived. If pressures continue, they're going to do everything that they can to make sure that those impacts are felt in a very short-term basis. Um, as we look at a bit of a different metric here, though, so PCE is just a bit different than CPI because it pulls in, a bit broader of a spectrum of spending. So it includes, more than just the out-of-pocket spending. It includes spending on behalf of a lot of consumers, so things like employer-based healthcare and stuff like that. And so as we look at some of these projections here, um, near-term expectations remain slightly elevated around that 3% mark. Um, by both market and survey measures. So, market expectations doesn't often jive with sort of the sentiment of the consumer. And so they kind of weigh those things back and forth. Um, and so we're looking at, maybe 3% to kind of close out the year here for inflation yields, or I'm sorry, inflation rates. They're looking at potentially 2.6% inflation for 2026, and then kind of down towards their goal for monetary policy of that 2%. Long-term expectations, that's kind of where things are remaining consistent. So really just kind of watching both sides of it. We're going to talk about jobs here, but obviously the Fed has a dual mandate of making sure that inflation is kept at bay and that they reach full employment. So those two things right now are kind of battling against each other in terms of how the Fed is choosing to move forward. They felt comfortable enough this past month moving on uh, um, the federal effective rate range by 25 basis points. But as we kind of look at the employment report here, so unemployment edged up to, 4.3%. But it's really little changed, I guess, historically speaking. There's a lot of headlines out there, like large layoffs. UPS laid off like 48,000, or they were going to. Target said they were laying off 1,800 people. I think the the largest number I saw for Amazon was somewhere around 36,000, but then they kind of backed off of that and said it's going to be closer to 18. But, Microsoft, GM, some of these larger companies in the United States are looking at these larger layoffs. Many of them are due to restructuring. The AI actually is the culprit for a portion of it. Obviously, Amazon is a massive AI company these days. And so they're all looking for these types of efficiencies, but the economic factors like the tariffs, a lot of companies are actually eating the cost of these tariffs, but they're making up for it on the labor force side. So they're cutting their labor force and just eating the cost of it. So the price of their goods don't increase. Um, but consumer spending is also part of that. So the demand for a labor force is actually down as well. There's changes in immigration, so the supply of workers is down. And when you have a demand that kind of drops as well as the supply of workers, it leads to kind of an elevated unemployment rate. But the consumer spending part is actually really interesting because I was looking at some reports the other day that suggested, the top 10% of earners in the country are actually responsible for like 50% of the consumer household spending over the last year. So pretty remarkable. But one of the things that is really difficult to kind of speak to as we look at sort of the Fed expectations here. So Chairman Powell on September 23rd, one of the things that I love doing is going out and kind of reading through the whole script of, his media time after they meet. And he was quoted in saying, near-term risks to inflation are tilted to the upside and risks to employment to the downside, which is a really challenging situation because, you want to cut rates with inflation kind of trickling downward because that's going to help companies grow. But at the same time, you can't cut rates too quickly because obviously inflation is still an issue, but now we have these jobs figures that are coming back with higher unemployment. So those things are really playing off of each other, and they're really moving forward cautiously. So what we're looking at here is the dot plot from their most recent meeting. Each one of these dots, and I know we've gone over this before, represents a vote from a member of the Federal Open Market Committee. And they meet regularly to discuss, their monetary policy, which, like I said, controls borrowing yields and employment. That's kind of their dual mandate right there. But um, as we move forward here, you can kind of see where the median is on some of these figures. So mid 2025, we were sitting around 3.8%, and that's about where we were as we head into 26. Mid 26, we're expecting to maybe be somewhere around 0.125, maybe 3.2% in terms of the federal effective rate. And it kind of keeps falling as until we get to, out into 2028 and they reach about that 3% or neutral rate, which is going to be a healthy place to be should we arrive at our 2% inflation goal. So, over here, we're just kind of looking at, a number of cuts basically according to when the next meetings are. So, zero point 0.6, zero point 0.6 cuts, by December 10th of this year. Really what that means is thinking about is like saying there's like a 63% chance or 60% chance that they're going to be cutting rates by 25 basis points. And that's really what is seen as one cut is kind of that 25 basis point range. And so as we head out into late 2026 or a year from now, we're looking at potentially being 75 basis points lower or near that 3% mark in terms of where that federal effective rate range is that controls the overnight borrowing between banks. And that is the rate that controls a lot of, investing yields that we do. It doesn't necessarily directly impact longer term investing, but they're correlated in time. And then it also controls, as time progresses, some of the yields that you're going to be looking at, in the municipal market. And we'll talk about that here in a second.
Yeah,
But
question, Matt. So
yes,
the December 10th, you said it's a 60% chance, according to the votes of the Fed governors, a 60% chance that we'll have a rate cut of 0.25%.
I would probably liken that just to more like market sentiment. So the markets are anticipating a 63% chance just based
I
on where
see.
the data is that they're going to move on rates by another 25 basis points. I
Okay.
have another graph that we'll take a look at here in a second that'll kind of talk to that. But really, I think the point here is that they're working away from their restrictive monetary policies towards their neutral monetary policy of that sort of 3% federal effective rate. Restrictive meaning, higher interest rates are restrictive upon growth to companies because it costs more to borrow, which means it costs more to grow, stuff like that. So this next one, I don't have a ton of detail. This is basically the target range for the federal funds rate as it has grown over time here as we exited COVID. Moving forward, this is the median projection here. Um, but what we have in green is basically the 70% confidence interval of, hey, we're fairly confident that the federal funds rate is going to fall within this range, mid 2025. And as we kind of go out in time here, how we talked about jobs being an issue, but inflation's still not really tucked away yet. As we move forward, they're hoping that we arrive down at this 3% mark, but there's just some uncertainty in their projections, and they're just hoping the data keeps turning the way that they'd like it to, so that they can return to their neutral monetary policy. And this is kind of the tool that I look at quite a bit and I discuss with a lot of my clients in terms of, where are we looking for fixed rates versus where potentially liquid interest rates are going to be. So this is where we are today. It's 3.75 to 4% in terms of the federal effective rate range. There's this 65% chance as of, here today that um, the markets are saying that in December, there's a 65% chance they'll cut. And then, they won't, the probabilities aren't there that they'll cut again until maybe April. But then, here we are at that 3 to 3.25% range, possibly in July of 2026. And these are all probabilities. So these change fairly frequently. But this is just this is one company that puts out a Fed Watch tool in terms of the probabilities of where the Fed is going to be. So they've cut a couple times now. Interest rates aren't done declining in order to reach, that healthy economy of 2% inflation, 3% federal effective rate range. We've got to cut a couple more times here. It's just really a matter of how far they need to kick the can down the road because of some of these jobs numbers, and obviously where is inflation going to come to. So, um, but what that means for today, uh, the the Fed cutting rates is going to impact investment yields faster than it's going to impact your borrowing yields, mostly because, you're borrowing on a much longer basis. And you can see how much further the spread is here in terms of where yields used to be versus where yields are today. So a year ago today, we were still around 4.6, 4.7% on, the daily yield, basically, in terms of investing. A year from today, we're projected to be, closer to that, 3.5% mark. But out here, when you get to the 10-year and the 20-year, there really isn't much spread in terms of the impact that these moves have had so far and on the investment side. And we'll take a look at some of the borrowing side too. Um, but one of the things that we have available to us is, these expectations. And what we have here is these are investment yields as they compare to, well, not, they don't compare, I'm sorry, as they kind of correlate to where liquid yields may be at the point of maturity. So for districts that are looking to invest out, some of their operating, perhaps, come December, many of them are going to be out of the red. They're going to have, funds for another 12 months. So if they want to look at a 6-month investment or a 12-month investment, at the point of maturity, 6 months from today, some CDs are going to be 50 basis points above where liquid yields are going to be. So you're basically just extending yourself out over those dropping yields. So instead of riding that downward, you're kind of held up above it around that 4% mark. And it just kind of goes out, 12, 18, 24, 30 months, 36 months. We don't see a ton of 30 to 36-month investing. Mostly that's just like Fund 46, stuff like that. But these Fed futures here, this is kind of what we just talked about with those dropping federal effective rate yields and how they impact liquid investing. And then these are just the fixed rate yields and where you can invest to at that point in time. So really just making sure that if people have the ability to, you know, um, they have access to fixed rate investments out there that are going to make sure that their earnings are going to be maintained at the very least, as opposed to dropping with these liquid yields, whether it's, $100,000 or $500,000. The opportunities out there. And so it's just important to make sure that people know they have access to all of them. So um, and then the last kind of section that I was going to take a look at here today was just talking about some of those municipal market kind of debt measures. And so this is like a graph kind of showing the interest rates of a AAA GO bond. The 20-year maturity, which is kind of the standard for when people are issuing, debt on the capital side, sits today at a 385, which is still elevated above, the last 15 years historically. But you can tell that, as of a year ago today, mid-November, we're markedly, probably about 100 basis points lower in terms of where you could be investing on the 20-year basis. But one of the things that I thought was really impactful, kind of going back to the last graph I showed. So this is going to be, AAA debt pieces for, this is 2 years ago, this is 1 year ago, 6 months ago, and then this is today. And you can see that the 20-year, though elevated, a year ago, 6 months ago, really has remained flat over the last 2 years. And the impact that the dropping rates have had on issuing debt really is most seen kind of like on the short term. So these 5-year notes that people are issuing, they're going to see a bit more savings long term. And the spreads between the 20-year and the 5-year have really grown quite a bit over the last couple of years. So um, any questions, I guess, kind of before I just get into sort of this time of year, tis the season of borrowing, um, about anything that I may have discussed?
Yeah, folks, feel free if you want to unmute yourself, you're welcome to ask any questions.
That's okay. So we do a lot of cash flows for school districts. Like I said, 107 school districts short-term borrowed last year. Generally speaking, most people are at their low point this time of year. And so we do have a lot of discussions about short-term borrowing. There's not a lot of options out there. but there's a lot of information about the options, and some people not don't necessarily have the time to maybe explore the differences between the two. So the three main options that we kind of discuss with people, and it's not all, one size fits all for any of them. A line of credit is definitely the most accessed point of um, liability relief. A lot of people have their local banks. They issue a line of credit, whether they tap into it or not. Everybody's kind of all over the board. And then we have the tax and revenue anticipation notes. I think everybody's at least familiar with those. But at least through us here, we do a pooled tax and revenue anticipation note. Really, what that's meant to do is kind of attract a, more bidders, better bids from larger institutions, because you're taking, 10 to 12 school districts, and you're kind of pooling that together, making any earnings that these institutions are going to make off of it just a little bit grander of a scale. The line of credit, one thing people don't know about it is that you actually can't draw on the line of credit after 6:30. So anything you might need between, June 30th and the end of the year, you actually can't draw on that line of credit. So you need to pull all of your money by 6:30 if you're going to need it for late November. Um, their lines of credit are generally tied to the prime rate. I do see a lot of local banks that offer, more competitive yields, but prime plus one or prime is usually what we'll see for like a line of credit. And then it's always kind of hit or miss whether there's, origination fees or not that are tied to it. With the trans, obviously you can go like a competitive or negotiated sale. I'd say that for issuing a tran, you're probably going to see more of a difference in terms of yield, going competitive, as opposed to negotiated on like a longer term debt issue. But we don't necessarily see that for tax and revenue anticipation notes. But yeah, so the one thing too that I was going to say about issuing a tran as opposed to a line of credit, you don't always need to hold it for that 360-day period. A lot of people think that you just hold it that whole time, but it really allows you to kind of define your own maturity. So no matter who you're working with, you can take a look at your cash flow and say, yeah, we can repay this after, April tax credits or something like that. That way you're not extending the debt out that you need any further than you need to. But which one's right for you? So length of shortfall. So some districts see multiple shortfalls throughout the year, sometimes November to December, sometimes in June. And so that's going to really define for you, how long am I going to need money for? What's the interest rate of that vehicle going to be? Is it tied to prime? Is it going to be competitively issued? And then investment yields, because sometimes people ask us too, like, hey, is it going to pay me to hang on to these funds a little bit longer, because investment yields are right around the point of where, we're going to be paying on the debt. And I will say that if you are issuing short-term debt, technically you do still need to file an arbitrage um, report for the earnings that you get off of those funds. I haven't seen many people actually do that, but that is something that does still need to be done. But going back to how you can kind of determine your shortfall. So having a self-directed cash flow is huge. Making a cash flow that you have the ability to derive different scenarios from is great. At the very least, having like a month-end cash balance for future cash flows is something that is really going to be helpful, if not for short-term planning and then just for administrative planning. But taking a look at the kind of the yields that we were talking about here. So this is this year's short-term municipal debt market. So all of these dots represents a TRAN issue in the state. Um, like I said, most people go with the line of credit, but the yellow ones are going to be kind of the pooled ones that we had worked off of with, I think we had 26 school districts this year, with about around like 80 million. But here's the prime rate up here. And so if people are working on a line of credit and they need to tap into it, if you're tied to prime, some of the yields that the districts are going to be paying is going to be substantially higher than where maybe the trend market's going to be. And so it's just worth kind of at least weighing the options, looking at your cash flow and trying to figure out, how much is this going to cost me one way or the other. So I just thought that was something really interesting to kind of take a look at. This is the 1 year index, so the 1 year um, bond index here. So yeah, and then I think that kind of wraps up what I had for at least, market updates, kind of looking at investment and borrowing yields. I did have I had prepped kind of just doing kind of like a walkthrough of what our cash flow software at least looks like. It's free for school districts. So if anybody wanted to see that, maybe they can hang on to the call. And we can kind of walk through what that looks like. But as of right now, I think I'm good with the market update if anybody has any questions about that.
I'll pause. I did have a question I wanted to ask you about that, Matt, but anybody else have anything on the market update? A couple things from me, Matt. So you said a line of credit you can't access after June 30th, so it's an annual kind of an activity.
Yeah, so you do approve the ability to, access short-term debt should you need to. But there is a statute that says after 6:30, you're not allowed to draw on the funds anymore. So anything you do need after 6:30, you are supposed to actually have drawn prior to that point in time.
Okay, so many districts need funding right now, December, November, December. Would it be a new board action and for the current fiscal year? Is that how that works?
Yeah, so yes. Yeah, so that would be kind of going back to, fiscal year 25, you're not able to draw on it. You have to basically just renew that every single year. And whatever resolve on your um uh short-term borrowing, line of credit now you're not able to access. You just basically need to renew it. And so
I
just
see.
just kind of a something to look out for, I guess. We've
Sure.
seen people just kind of carrying through the same line of credit year in and year out. And yeah, you're not supposed to do that.
Okay. Well, that's interesting and good to know. And then the tax and revenue anticipation note. It sounds like districts that participate in that get a little better rate, perhaps, because it's maybe more rewarding for the lender.
We definitely see, I think, an uptick in bids. And then the yields, because it's a rated pool, so the yields tend to be a little bit better as well. I mean, they definitely are lowest in terms of the state for where we're looking at, tran issues. Um, I can't say that it's going to be that all the time. This is just this past year. But yeah,
Mhm.
the pooled aspect really is a bit more rewarding for the investors.
Okay. And is that something PTMA helps with? Like people on the call could let you know that they're interested in one of those and you're putting a group together, for instance?
If they would like to at least take a look at it and compare it versus other options that they have, we're happy to share any information that they're looking for.
Okay, great. Thank you. Any other questions from anybody? Otherwise, we'll go into the cash flow analysis.
All right. All right. Can you still see my screen here?
I'm still seeing short-term municipal debt.
Um, Hold on. Let me see.
You might have to stop sharing and then move over.
Uh, Stop share. There we go. 1 second. All right. How's that?
Nothing yet.
Oh,
There we go.
there we go. All right.
Yeah, good.
Cool. So this is just one option that people have to them for cash flow. Like I said, it's free and available to school districts that need it, and we're happy to assist in any build outs. So there's multiple ways that you can kind of begin this. A couple things that at least we need for our purposes. We try and look at least one full fiscal year of revenues and expenses, current fiscal year budget. If you have next fiscal year's budget, that helps too. And you can either build out either revenue and expense history, or what you can do is just kind of use base projections for your budgets. I'm going to zoom in here. Maybe that'll help. So, so the way that this cash flow is built out, you have the ability to break it out by fund if you'd like. This one is just broken out by operating, but you can see that there's subcategories here: categorical aid, equalization aid, local taxes, and then miscellaneous revenues and other state aid. For expenses, it's kind of similar. They just broke it out into operating, AP benefits and salaries. Some people choose to do like teacher salaries versus support staff salaries just because they run on a different schedule, and that's perfectly fine. But once you get your budget in here, what you have the ability to do is say, let's say you're looking at some type of operational referendum that you may need to renew, and you need to kind of build out a scenario of, hey, let's see what happens if, oops, sorry, one second here. Let's see what happens. This is our 2026 budget. Let's see what happens if, we lose, let's say 5% of our tax base for 2027. You have the ability to duplicate this cash flow and kind of build out multiple scenarios in terms of, what does a future budget look like if we don't end up passing our operational referendum, which is kind of the biggest thing that leads up to, not being able to fund your liabilities like we just talked about. But otherwise, what you can do is install figures here for 2027, 2028. You can apply, 2% CPI adjustments just to make sure that, your budget is not necessarily what it's going to be, but what you feel like it might be. And then with your budget, you have the ability to come in here and say, all right, we have all these different categories. Equalization aid, we know it arrives 4 times per year, at least general equalization aid for most people. Tax levies, 3 times a year, sometimes 4 times a year, sometimes just two. But you have the ability to build out the schedules and say, hey, I want this to arrive, every September, every December, every March, every June, whatever. And then you can come in here and then if you're looking at your, let's see here, equalization aid. Let's see here. So for like miscellaneous revenues, you can come in and say, let's see here. Okay. You can go ahead and sort out your equalization aid and say, yeah, let's do 45% December, 35% March, 25% June. And then for taxes, let's say we get 15% of our taxes in August, we get 40% of our taxes in December, 40% in February, and then, the remainder comes in like June or something like that. So you're basically telling the cash flow, hey, we're getting this much money this fiscal year. I want it to be broken up by these different months. And you can do the same thing for expenses. Most of the time, this is going to be kind of more spread evenly across the year, except for, maybe a little bit more heavy weighted in June. So like we're looking at salaries, they have 8% per year every month, except for 12% in June. And so you kind of have the ability to take a look at your historical revenues, your historical expenses. You build out your budgets, and then it knows that you can break out that total budget figure by these specific months and these different percentages. And so what that really gives you is this beautiful grid here of, daily cash balances for 3 fiscal years moving forward. So we're looking at all the revenues here that are kind of built out by you within this system. So taxes, here's January taxes. There's some state aid that arrives here in January for this specific district. Miscellaneous revenues, salaries and benefits are going to hit on the 30th and the 15th, which you can build out in your schedules or whatever your payroll or AP schedule is. That way, let's say you put in, you can adjust your balances here, let's say as of 10/30. So you can click on 10/30 and say, you know what? I didn't have 13 million. I only had 12.8. And then you can go ahead and adjust your balances so that moving forward, your cash balances are going to be more in line with where you actually sit. And so you can kind of go through here and you edit these things on a regular basis. The dashboard here is I skipped over the dashboard. So it'll total up for you, hey, this is where we actually expected to be. This is where we actually ended up. So we were $500,000 shorter on revenue in the month of December. We hit our expense mark. And then you have the ability to either kind of compare and say, hey, this is our base projection versus our current projection. And it'll give you sort of an under over revenue and expense. Otherwise, this specific one is basically, let's say you were over under 500,000 halfway through the fiscal year, you can kind of just adjust each month moving forward so that at the end of the fiscal year, you arrive at budget. Most people, they want to arrive at budget. And so they kind of want to understand, you know, where it is that their expenses and their revenues are going to actually hit if we're going to arrive on budget. But if you're kind of looking at this grid here, you adjust your cash balances and you're able to move forward through time, and it's going to show you, where your shortfalls are going to be if there are any at all. And if you don't have shortfalls, these are our cash balances. What's our low point? What can we get away with doing project-wise if we need to spend out of operating right now? There's a lot of decent reporting that comes out of this cash flow too. So if you're taking a look at, this base projection wasn't adjusted for future fiscal years. So this specific school district was looking at a deficit of 371,000. You can adjust it moving forward, but it's going to show you your monthly projections here. It's going to show you your base projections versus your current. And then, like I said, you can break it up by fund. So like 10, 27, 50, 80. And if you don't do that, it's not going to give you this on the reporting side. But if you actually do build it out with that level of detail, it's going to show you revenue and expense analysis for each different fund. There's a total balance page here, which provides just a little bit more of a visual representation of where you sit in time versus future months and future years. It's going to show you your minimum fund balance. So like fiscal year 25, what's the lowest balance that we have that fiscal year projected? Fiscal year 26, and forward. It's going to show you your absolute minimum low point, at any point in time, 11, 28, 25. This particular district's low point is 6.8 million. And so this is one of the tools that we use to identify short-term needs for school districts, and it's free to anybody that wants access to it. Obviously, if people have their own self-directed cash flows, that's excellent. But one of the other things that comes from this is that there are some districts that don't need to short-term borrow, and they have the ability to sort of build out an investment plan. And so this is not as used, just because funding in the state of Wisconsin is all over the place for each district. But what you can do is you can come in here and say, hey, I want a minimum investment amount of $100,000. I want it to go up 100,000 from there. Maturity is not closer than 14 days. Minimum maturity, 1 month, maximum, 730 days. And it's going to go ahead and optimize for you based on your funding dates and your liability dates, all of these investments that you can kind of make over time so that you have the ability to always be in the market. You have a disciplined approach. You're accessing, all of the bidding networks that you have available to you for, yields above liquid. And it's going to show you exactly when you can invest to, and you can build it out so that things mature a couple days prior to maybe like an AP run or a large payroll or something like that. So kind of a neat tool that we have here. Obviously, I hope everybody has their own kind of cash flow. But yeah, so that's kind of just a little walkthrough of CF Max, and
That's the
yeah.
graph I remember from when you showed this to us about a year ago, Matt. And I think that's really neat. And I think the one that you used as the example a year ago had the district dipping into the red. So they were in the, above the line and below the line at different times, and they could identify when they were going to be short as well.
Hmm. Yeah. Um, it's been great for us. Any questions at all about the cash flow or any of the market detail that I had gone over? I'm happy to kind of rebuff on it, some of it if anybody does.
Yeah, Matt, Paul Schley from Cornell. I'd love to get that from you. I know I've worked with you on a lot on stuff, but this is really neat. And I hope everyone looking at this can see the benefits of this thing. Because right now I just been kind of guessing on my own. Okay, I should be good here, there, but I really like how this lays it out, and more importantly, not for me, but for the board to say, hey, here's where we're gonna have money so we can invest and get some things done. So thank you for sharing this.
Absolutely.
Yeah, it's really neat too. As districts run operational referenda, you know, and just what you were saying earlier, Matt, like we're going to get this tranche of money. How are we going to use it? When do we need it? What are our expectations? That's very cool.
Oops.
Must have
Okay.
been a lot of work. Well, okay, I think we're probably at the end here, unless then there's any other questions from folks on the call. All right. Well, thanks again, Matt. Really appreciate your time and the intel and the background that you bring to this. It's funny, now that we're 3 years in, I start to get used to seeing some of those charts and they make more sense. And it's just kind of coming clear. And did you have a background in economics? Because you're so fluent in all this stuff.
No, I don't. But I've been in the securities industry for going on 13 years now. So
Nice, nice. Well, it's really helpful. Thank you. All right. Well, we'll get the video of this posted. And Matt, if you could shoot me the slides. Thanks again on behalf of AEF. Thanks everybody for joining us today. And we'll see you probably in about 6 months for the next market update.
thanks, John. Thank you.